Testing. Anybody can hear me? What's going on here?
Turmoil, so the trade can upend, and then it forces the investors to obviously get out and repay the leverage, repay the loans. That's a lot of what people are talking about this morning, Jim, in terms of why we've seen this added move. Maybe it's playing itself out, and that's why you get this talk about, well, will the Fed have to do something? Right now, there's enough liquidity, is my understanding, and Steve Leisman confirmed that as well.
Right. Well, once again, I mean, you got to deal with the reality of the price you look at, and the 10 years 4.35, and we can be all crazy about it, but
yeah.
But you know what we have to say is, well, what's the big deal? What's the big deal? What is the big deal?
Heading into a recession, one would anticipate rates would have moved significantly lower. But by the way, have you looked at oil?
Well, oil is
okay as a reflection of an expectation of demand.
That's true. It's
oil. So I would expect that would be the case with the 10-year, that it would be trading as it did briefly, well below 4. Not but below 4. Look at crude.
But you're dealing with a piece of paper that is owned heavily by the Japanese and by the Chinese.
Yeah.
And if that's the case, and you're offering that paper today, and the Fed is not going to be buying, I mean, that's just a lousy piece of paper.
By the way, that's a
lousy piece of paper.
That's a 4-year low on WTI.
They should be filling that
on crude at least.
What a great time to fill the.
It was down. It was down about 18. It was down 18.7% coming into this morning's session, and you can see, adding to those losses, we are now talking at least a 20+% loss.
I'm sure the president will be crowing that you worry about inflation.
And that is a 4-year low.
Everybody pays.
You want a bright spot? Prices at the pump are coming down.
Right. And it's for real.
I can no longer say there's a bright spot any longer about mortgage rates coming down.
No, they're not going where they're going to. But when stock prices go down, housing prices have gone up, but transactions dry up. That's why you're seeing a lot of the home-related retailers not do well today. But I do take solace in that oil going down is it is very good for our country. It's just good. Natural gas would be better to go down. It's not, because we want our natural gas to trade lower. We could be a great exporter. What are you hearing about data centers?
I'm hearing things may be finally slowing down a bit.
Right, that's the word.
Yeah, I mean, by the way, it's kind of burying the lead because, of course, that would have been a story that we would have led most broadcasts
with. That's why I figured by 9:50 when I'm almost kicked out of here.
I think it's hard to imagine that wouldn't be the case, but for the first time I'm sort of hearing, at least from the people I've relied on to tell me about the actual deals, that maybe things are slowing.
Yeah, and it's Microsoft. Plus, I've got the one thing I would warn these companies that are cutting back. Like every day, I mean, today is Perplexity Day. Yesterday was Grok Day. I mean, if you're going to be in this game, you need NVIDIA. And I got to tell you, I don't know which one you're using today. I have now decided I can go to Perplexity and I go to Grok. I say who I am, and it says, "Booyah, Jim. Here's your answer."
Look at that. I would point out it was 9:51 before you mentioned the word NVIDIA. It's a new record.
Do you remember the old days?
Congratulations.
Yeah, the old days.
I miss the old days when you'd mention
Really?
that instead of
David,
Peter Navarro.
I got 2 words for you. Be cool.
Let's go tell you more about the bond market, and we have a bond report here. Even though we've given you, I've talked more about the bond market in this show than I ever have.
I know.
Can't we just show people yields? We've discussed it,
Wow, there's real movement.
and then some.
God, we make the world 10 years the same price as it was. You know, why don't we tariffs? That's what you have to focus on because they're recession.
Okay, we'll be right back.
This time. If he builds the wall, he lied.
Orlando Resort.
All right, let's get to stop trading. Jersey United Health yesterday, in part because of the changes in Medicare Advantage, had a good day.
I'm using it as a metaphor.
Okay.
Right now, there'll be a lot of fund managers who say, why do I need any of this? Just give me stocks that are American stocks that have nothing to do. And United Health, which sells at 19 times earnings, would probably sell at 25 times earnings in the near-term future because United Health actually defines what I'm telling you people want. Up another 12 today. And that's how money managers work. They'll buy Humana, they'll buy UNH, they'll buy Cigna.
Does the cost of medical care go up?
If he builds-
it's coming from somewhere else and suddenly it's got a tariff on it? Or
and
no?
Medicare's going to pay for things. We just got that new
Medicare Advantage.
Yeah, medical
increase.
advantage, which, by the way, I don't think someone asked
So
me,
it doesn't
Jim, are you really
bleed
saying
through
medical
to the
advantage is
cost
that
of
great?
care
No, it's
and
not.
therefore insurance rates, and they get hurt somehow? No.
No, you're looking for immunity. You're looking at Cintas, okay? Cintas, the uniform company.
Yes.
You're looking at paychecks, the immunity.
Yes.
Now, I know this small business confidence was down, but they're
Okay.
still starting. But that's the new thing, David. You're going to hear people come on, like on two stock lunch or whatever, and they're going to say, you know what? I like United Health and Humana here. Why? Well, they're totally independent.
Totally
of the-
domestic.
right.
Yes.
And then people are going to say, ooh. So I just gave you UNH at 560 ahead of when it's at 660.
Thank you.
Thank you very much.
So much for that.
And
Jim.
David, remember what the watchword is today?
Oh, tell me. Be cool.
Ooh.
All right. Don't
You don't
go
have me to
anywhere.
kick around
Be
anymore.
as cool as you want, but just stay with us. We got all the major indices higher in early trading. We're back right here.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with David Faber and Mike Santoli. Carl's on assignment, and we are live as always from Post 9 of the New York Stock Exchange. Stocks are trying for a big rebound. We've got another up and down day here. Take a look at the action. The S&P 500 is actually higher by 1%, which you wouldn't know by all the headlines flying around and the volatility. Technology is leading. We've got information technology up 2.5%. The stocks that are lagging, energy, real estate, healthcare, and utilities. That's why the NASDAQ is, I would say, surging now 2% compared to where we've been and where we were. Keep in mind, it's still like 19% off the highs, but we are coming back today. A lot of the action is in the bond market. We're going to really dive into this, but let's just show you where treasuries are right now. They're selling off with yields higher. Third day in a row, we're going to talk about the dynamic because a lot of people are paying attention. It's become sort of the center of the action. But right now, we've got a 10-year yield off the highs at 4.365%.
Yep, a lot more to come on that. Another volatile day of trading, of course, as well. We've got wall-to-wall coverage of what you need to know this hour. Eunice Yoon is live in Beijing. She's going to have the latest on China's moves regarding tariffs. Angelica Peebles is tracking the big moves in pharma. This as President Trump plans new tariffs for that sector. Phil LeBeau, he's got the airlines, of course, following that pulled guidance from Delta. But let's start with Rick Santelli, who is tracking that action in the bond market. Talking a lot about the basis trade during the last hour as well, Rick. I know you've got some data for us as well.
Yes, let's start out with the data. This is the February final for wholesale inventories. Mid-month read, up 0.3. It remains up 0.3 and up 0.3. Well, up 0.8 was January, to give you perspective, and the end of last year we were minus 0.7. If we look at trade sales, this is a fresh number, expecting up 0.8. Buckle up. Multiply that by 3. 2.4%, up 2.4% to find a higher number on sales. You're going back to March of 22. Very solid. And last month's minus 1.3 gets upgraded only minus 0.9. And as David Faber pointed out, lots of action in the Treasury complex. And by the way, 39 billion reopened 10s go for auction 1 Eastern. There's an auction you don't want to miss. Yesterday's 3-year wasn't a good auction. And with today's movement, consider this. We settled at 430. We're currently at 436, up 6 basis points. You know what the high yield was? 451. Now, everybody out there is talking about liquidity, and some say we have a liquidity issue. Others say we don't. I used to trade. This is an easy one. Liquidity, well, it's how many 30 seconds you need to move a certain amount of size in the market. The bigger that distance is, well, the less liquidity there is. So when you look at the ranges, that should smack you right between the eyes that with those type of dramatic moves in the last 10 hours, there is a liquidity issue, but there's not necessarily a liquidity crisis. David and the gang, back to you.
Yep. Hope we stay on that side of it. Thank you, Rick. Europe and China both announcing tariff moves this morning. Eamon Javers at the White House with more on what Europe is now doing. Hi, Eamon.
Yeah, Mike, that's right. We saw this retaliation from Europe this morning. Just a short time ago, European Union voting in new tariffs on about $23 billion worth of American goods, including U.S. agricultural products. Now, our Megan Casella points out that's just the beginning of what we expect to see ratcheting up in terms of tariffs from the European Union as their voting mechanism comes into place and they move through the process on their side. So we do expect more from the Europeans at some point. We've also got some reaction now from President Trump on social media. The president urging folks not to panic here. He's putting out a tweet saying, "Be cool. Everything is going to work out well. The U.S. will be bigger and better than ever before." He also put out another post on social media saying, "This is a great time to buy." And he signed it, look at this, he signed it DJT at the bottom of his Truth Social post. Now, that signature line of DJT seems to have gotten some people's attention because that's also the ticker for the Trump media company. And if you look at what happened in the Trump media company, you see that spike right there after the president put this out on social media. Unclear whether people thought he was endorsing his own stock here or whether this was just sort of an automated response as black boxes got in the DJT ticker. But in any case, we are seeing a move now in that DJT number on the back of that Trump social media post. So a lot of moving parts here, guys. Ultimately, this White House is saying right now, stay the course, be cool. Everything is going to work out just fine.
You know, a lot of people were relieved that Europe went for tariffing goods, but I do wonder if it's premature because, you know, Europe has to get 27 members on board and they have to vote on this. So this was the first action, but I do wonder what's coming when it comes to services. They have the Digital Markets and Services Act. They're trying to regulate AI, and there could be some pressure they can put on the U.S. companies via that, right?
Yeah, it seems clear there's more coming from the European Union. This is just maybe the first of many steps that they can take. And then the other point in all this, and you know, this might be obvious for our audience, but not necessarily for people who are new to this, is that, you know, this is a multidimensional fight now. It's not just tariff against tariff. It's the treasury markets, it's regulations, it's efforts to grind U.S. companies down in terms of their market share. All the different levers on the economy that governments have now come into play as countries around the world look at how they particularly are going to retaliate against the United States. So you watch the move in treasuries overnight and you think, is that a retaliation by a nation state such as China, or is that just a reflexive move by hedge funds in the United States to try to reposition themselves? You know, we don't know that right now, but you have to watch all of that, not just the tariff versus tariff retaliation.
Without a doubt, Eamon. And of course, we have talked about China and whether they are selling our treasury bonds as well. Eamon Javers at the White House, thank you. Speaking of China, of course, retaliation also does come in the form of higher tariffs, and Eunice Yoon joins us. She is live from Beijing, can give us the latest on China's response.
Yeah, well, that's definitely right. In just 2 hours, the Chinese retaliatory tariffs are going to go into effect. And this is after the Chinese had decided to raise the tariffs on all American goods coming into here to 84%. This is the additional tariff, and it was adjusted in reaction to President Trump's his increase. So this is in addition to that, the Chinese government have named 18 companies that are going to face restrictions in the form of being on the unreliable entities list or on the export control list. So this means that companies wouldn't be able to source from Chinese suppliers of dual-use items. So all of this matches the general messaging that we've heard out of Beijing, and that is that China is going to stand firm. In fact, in the first public speech that President Xi Jinping had since escalation, he presented himself as a defender of multilateralism and also said that he would strengthen the ties with neighboring countries. The People's Daily, which is the voice of the Communist Party, has also cited some of his comments recently in an op-ed saying that the best way to weather the storm is to focus with unwavering determination. The Commerce Ministry today also argued that China has abundant means to retaliate. And interestingly, they also tweaked their language around a TikTok sale, saying that a TikTok sale definitely required Chinese approval. Guys?
Who's going to reach out first, Xi or Trump? I mean, it's like impossible to psychoanalyze these leaders.
Well, I would think that for the Chinese to make any move, the conditions in Washington would have to change because like President Trump, President Xi needs to be seen as the superior person, the one who has been able to save China and be able to rejuvenate this country. So, they cannot be like Xi Jinping and the people around him would feel that he cannot be put in a position where he could be humiliated or he's seen as a weaker party. It's also part of the Chinese party's diplomatic ideology. So at some point, the conditions would need to change in Washington to allow for the Chinese to be able to even broach the Trump administration.
Okay, Eunice, thank you. No communication at this moment. Eunice Yoon in Beijing. Look, the first place you have to look today is the bond market because that was the stunning move that we saw overnight. And it was just, it's a little confounding because initially, after Liberation Day and the markets plummeted, everybody ran to treasuries as a safe haven to buy on bets of recession, on bets of safety. Well, guess what? That completely reversed about 3 days ago, and it really started to move overnight. People were watching the long bond, the 30-year, because we saw a big jump up in treasury yields, and that gets people's attention. And the folks that I talk to, it makes them more nervous than what's happening in the equity market. Why? Because you're seeing U.S. assets dumped together. Stocks, bonds, the dollar. We'll talk about stocks in a moment and how they're being a little resilient here. But this idea that it's, first of all, stagflationary. Could be concerns about inflation coming as a result of these tariffs. It could be this so-called basis trade, which you've heard a lot about. It's basically what you need to know was a huge trade, like $1 trillion trade that when unwinds, it cascades and potentially can seize up the market. That's what Rick Santelli was talking about, how liquidity issues but no crisis. It's something to watch because then you get into
the difference in price between cash treasuries and
futures. Yes.
You lever that up big.
Right.
It unwinds. You obviously have to cover that, and you sell treasuries.
You own the actual bonds, and you're selling the futures.
Right.
And so when it unwinds, you're selling the actual bonds.
You're selling the bonds, right.
That's the technical definition of it, but I think the important thing to know is just it was a lot of leverage and a lot of money into that trade, and it reminds us of 2020 when the markets did seize up. As a big trade like that starts to unwind, is it foreigners selling? Look, that's out there too. I haven't heard a lot of evidence yet of that, but as long as that worry is out there.
We keep bringing it up, Sarah, but we don't know.
No, we don't know. There was a week 3-year auction yesterday, but it was not from the foreign side, actually. There's going to be a 10-year one today, which we'll watch, of course, but it's out there. As this ratchets higher, that fear is out there. So the problem with all of this is You know, the best case I've heard from what the administration is trying to do here is, well, at least they're getting lower treasury yields and they can refinance the debt at much cheaper rates, and that's going to really help them.
Big refinancings coming up in
big refinancing.
In a month or so,
so that was why it was kind of considered like, okay, maybe there's a grand plan here.
It'll be helpful for the
but when
budget.
it goes the
maybe
other
give
way,
them more room. It's terrible.
It's not.
There's
That doesn't
coming out
happen.
of this.
We're paying higher interest costs.
Yes.
It's painful
higher
for an
mortgage
economy.
rates. I mean, at least we could point to lower gasoline prices
Exactly.
and potentially lower mortgage rates. We can't do the mortgage rates anymore, at least as of now.
No, we're higher than where we were before.
By the way,
all
Sarah,
storms.
I don't know if you've taken a look. The municipal bond market also got hit yesterday pretty sharply. I think we have a chart. I mean, look at that.
Well, see, this is what you worry about.
That's not supposed to
Obviously,
happen
the
in
yield
munis.
effect,
No.
The yield effect has the real world borrowing cost impact. But the thing, and Sarah, what you're talking about overnight is the worry is that you're starting to see dislocations in the market. You're seeing forced unwinds of all kinds of trades, forced liquidations of all sorts of assets, or just a backing away from dollar assets
Correct.
in general.
That's the worry.
You have oil, dollar, bonds, stocks all down. And whether it's active selling or not, the
It
price
has an
effects
impact.
are what they are.
Yes, and that,
that's
by
what
the way,
we
makes
worry
it more
about.
expensive for municipalities to potentially borrow
Sure.
if there's any liquidity
Well,
at all.
there's a question about, I think, the U.S. exceptionalism story overall for U.S. assets. And I think that, it raises the risk premium to own U.S. assets. And so, first of all, you've got an unwind of that story that's been going on, and then foreigners taking a look. But I think what Mark Rowan said was really interesting today at Apollo on Squawk Box. He was saying, okay, there might be some brand damage to USA. That's one of the reasons he's worried, and he doesn't like how they rolled out this strategy.
Yeah.
But ultimately, he said there aren't that many alternatives. I mean, he said that he had a conversation with, his folks internally about buying German debt, for instance. Instead,
Right.
it's just not.
There's not enough of
There's
it.
not enough of it.
Yeah.
It's not a deep. There's a reason that treasuries are the deepest and most liquid markets, and that's why people flock to them.
Exactly. I would say treasuries are like the water in the pipes of the global financial system. Like you have to keep the pressure up, and that's what it is. It's the collateral for everything. There's no real alternative. But where does the world get the dollars to buy our assets? From our trade deficit, largely.
Yes. Yes.
Okay.
That's what it is.
That's where it comes from.
That's right.
So if the tariffs work, there's less money to buy assets.
Exactly. I've been hearing that argument this morning as well. Over time, that is and then what? Is the Fed going to have to step up?
Or we have to internally finance the
Well,
debt
that's
more,
the bet
and
that the
that's higher
Fed, if as soon as there's liquidity issues or dislocations in the bond market, that's Fed on alert. And
is this move in the muni market, again, I come back to, we don't talk about the muni market too often, but is it also a sign of real concerns about a recession and what that's going to mean for municipal revenues?
I mean, I guess on the margin, but I think it's much more probably a trading effect.
Dislocation.
And basically,
just an unwind
people
of
are liquidating
US
in general.
assets.
It's a
and
bigger
going
move
to
than we
cash.
saw during COVID, I think, in a one day. I mean,
we're seeing a lot of COVID-like moves. How about the VIX at 53?
By the way, when the treasury prices go down, that's part of it too. It's obviously the actual underlying.
So we're watching bonds because I think it's freaking a lot of people out, clearly. But interestingly, the stock market is behaving quite well with this move out of bonds.
It's trying to find its footing. And I think even overnight, the equity futures arguably were underreacting to what was happening in bonds and other markets. I think part of the reason is if the equity market were just in a vacuum, it's done a ton of downside work. And all of the washout conditions that you saw Friday into Monday are of the sort that says this only happens. Clusters of this type of persistent deep selling happen in the vicinity of when the market just has some kind of a snapback.
Yeah.
You don't know if it's going to happen. When the VIX is at 50, it means nobody knows if you can finally get any traction. But I think that's the reason. The equity markets have done a lot of work. And I know we're going to talk about the company guides. I said this at the close yesterday. Yes, of course companies are going to pull their guidance. Of
course, yeah.
The key is how the stock market reacts to that, because it's going to tell you if the market got ahead of it. And that's what seems to be going on.
All right, Delta is a good example. Then.
And Walmart.
Stock Walmart really didn't even pull their full year.
That's
they pulled
true.
the current
Operating.
quarter. But Delta did, and the stock's up 7%.
After getting cut in half, it's bouncing. That's kind of the world we're in. Have we done enough damage going into this?
So we are starting to get a taste of how messy it's going to be from companies and the real world impacts of all of this. Here's Delta. With broad economic uncertainty around the global trade, growth has largely stalled. 2025 is playing out differently than we expected at the start of the year. No kidding. Given the lack of economic clarity, it's premature at this time to provide an updated full year outlook. Walmart first quarter operating income growth, hard to predict. The range of outcomes, they say, is widened due to less favorable category mix, higher casualty claims, expense, and the desire to maintain flexibility to invest in price as tariffs are implemented. Walmart arguably is in the best shape. I mean, retail is going to be really ugly this week. And then the only other company I wanted to highlight, just in terms of real world impact and growth impact, is, did you guys see what Land Rover said the other day? Land Rover said, which is owned by Tata, it's going to halt U.S. shipments for now amid these 25% tariffs. The difference between Land Rover and Mercedes and BMW is it doesn't have the U.S. factories, so it's going to be hit much harder as a result of the tariffs. And I bring it up because there are other companies like this, and you know, these companies have to pay the tariff rates no matter what happens with the sales of their cars. So they have to pay the higher tariff rates, but they don't know what the demand,
have to pay the rates,
and they don't know what the demand is going to be on the other side of that. They have to pay the tariff rates either way. Get it? So it's a tougher.
Before they even know if there's a buyer for the product.
Yes, especially as they ship to these auto dealers. So I just think we're going to learn a lot about the supply chain. About import export.
What did Nike say? Did they say something about we can sell to the rest of the world as well, even more so?
I mean, they do. They have business
know,
with the rest of the world.
yeah.
More than half their business is outside the United States. But, you know, the U.S. is its most important home market, and none of the sneakers are made here.
I know. But what is it going to look like when they have a 46% tariff?
That is one of the arguments,
or
though,
whatever the
which
number ends up being.
Which is that every other country that the U.S. is tariffing only now faces higher tariffs against the U.S., whereas the U.S. is essentially on every front with every other trading partner has these frictional costs. And you know, that you're basically imposing on every economic interaction.
I think the second that President Trump posted about Vietnam, there's hope that they will be a country to make a deal with.
Yes.
That, you know, these especially Southeast Asian allies of ours around China, maybe we don't want to pick the biggest fights with them. Japan and I think Korea are mentioned as potential, but we need to see some deals. They need to start making these deals.
Yeah, or
Could
just
we have actually tried to negotiate before we put the tariffs in place? Might that have been a better path?
Well, like Rowan said, everything all at once, everything everywhere all at once.
Yeah, you have to
strategy.
You have to hold the gun
maybe
to
not
your
the
head
best
and
way to do
say,
it.
Either I get my way or the hostage goes.
Well, but the other question is, what are they
I think
negotiating?
they've already shot the hostage.
Yeah.
Peter Navarro said we want to close the trade deficit with Vietnam. Like, what? We're going to get them to buy as much stuff
I
as
heard
we
him
buy
say that
from
on
them?
a Sunday program that we're going to get them to buy $200 billion worth of stuff. They have a $429 billion GDP. They're never buying $200 billion worth of our stuff.
Yeah.
Big picture, the way the market has worked itself into this spot is, you know, it's become a cliche that, you know, markets panic until policymakers panic. The pre-market action today felt like whether it was Bessent saying the allies are going to talk, whatever it was, whether it was just yields coming off the boil, whether it was just chatter about maybe, you know, the Fed's going to have some kind of, whatever it was, the market is conscious of that upside risk of just like getting killed if you're leaning against it in this moment. So I think that's why we're so twitchy.
But no policymakers have
Nothing's
panicked
happening.
yet.
Nothing's
I
happening.
mean, there are a lot of headlines on the tape from Bessent, and not many from Navarro and Lutnick this morning,
Didn't
which
you
people
hear
are taking
Sarah,
note about.
just be cool.
Be cool.
Be cool.
Be cool. All right. As we head to break, here's a roadmap for the rest of the hour. Delta Airlines, as we mentioned, saying growth is stalling. We're going to talk more about the fallout for the airlines.
Plus, CEOs becoming more vocal about the impact of tariffs. We'll speak with the CEO of furniture retailer Ethan Allen about what it means for them.
And President Trump is talking tariffs for big pharma. What that could mean for that sector. We'll have that story. Squawk on the Street is right back.
Yeah, of course.
Let's give you a quick check. Oh, hi, Mike. There I am. Quick check on the worst sectors of the year. Tech and consumer discretionary officially are in a bear market. That means they're down more than 20% from their highs. Communication services and energy just on their heels. Semis, Zebra Tech, and Teradyne, for example, among the names leading tech lower. And those are all down over 40%. So far this year, Sarah.
Broad market, S&P coming off its worst four-day losing streak now since October 2008, depths of the financial crisis. Our next guest recommends investors remain more neutral and less on offense. Keith Lerner, Truist Wealth Co-Chief Investment Officer, joins us now. What does that mean, Keith? What are you specifically telling your clients?
That's a little bit old, actually. I'm telling our clients today is a little bit different story. Back in February, we thought there was a lot of complacency in the market. At least now we're starting to discount a little bit of at least a little bit of this, this uncertainty, right? We're down 19% from a high. So what we're telling our clients is that this is time to start thinking more about two-way risk, not just downside risk, but risk to the upside as well. We think ultimately this has, this whole market kind of process will take time. But as I mentioned, back in February, you weren't pricing in really any uncertainty ahead of all this risk. Now you're down 19%. The typical recession is down about 24. So effectively, you're pricing in more than a 60% chance of recession. You're seeing this market the most oversold that you've seen since October of 2022. And as just one example on the fundamental side, the Mag 7 PE is now at the same level it was when ChatGPT came out in October of 2022. Now, that doesn't mean there's not earnings risk. But again, I think the equation is becoming at least a little bit more favorable than it had been.
So sounds like you're buying, or you're recommending buying or dipping back in, specifically in tech?
Well, we're telling our advisors that, hey, this is going to take some time, volatility costs, but we would dollar cost average into the market. A lot of portfolios have shifted because of this movement down in equities. Consider rebalancing as well. There's also opportunities for tax loss selling. So there's things to be doing to take advantage of this. And then more specifically, we've been more neutral in tech. But I do think, if you look at some of these companies, you're down now for the S&P tech sector, down to about a 21 PE multiple. Last July, you were in the mid-30s. Again, there's earnings risk. I want to make sure that that's clear. So maybe that PE is somewhat depressed. But these companies aren't going anywhere. They have a lot of cash. And the AI boom, which everyone was talking about 3 months ago, is still alive and intact, even though it's not front and center anymore.
Keith, I hear you about the average recession. You get a 24% decline in the S&P 500, but it's been 35 years since we had a recessionary bear market that was less than 35%, right? If you can count COVID, and then you have, the global financial crisis, and then you have 2000 to 2002. So I guess the question is, given the sequencing of things where we went down 19% before earnings estimates started to fall, before we really started getting negative economic numbers, what do you think you would want to prepare clients for psychologically in terms of what we're going to face in terms of news flow from here on the fundamentals?
Yeah, no, it's a fair point. And I think the question, too, is even if we have a recession, is it going to be typical based on this disruption, which is somewhat abnormal, right? So, and I think timing matters because in our view, Mike, is, we've done this very quickly in a linear fashion. So there's certainly a case that we could go even well below that, eventually. But I think in the interim, I think the upside, let's say over the next month or two, is as much, if not more, than the downside at this point. And I do think this market's likely capped on the S&P, call it 54, 5,500. But again, if you've gone through this 19% correction, you are oversold. We're also saying this is, if you can withstand it, this is not the time to panic sell into this, because when we look at those volatility clusters, they tend to, the big down days tend to be followed by the big up days. And over the next 2 weeks following these big down days, you tend to have a minimum rally at some point of about 10%. So I think context is important.
But so you talk a lot about the valuation and positioning, but what about the fundamentals and the fact that we haven't seen any trade deals get negotiated, which was one of the catalysts for the market coming back? The fact that the bonds are now going the other way and selling off. Does any of that make you nervous that there could be further downside, even if you like the valuation story?
Yeah, and when I say valuations, I was talking specifically about tech. The overall market, I would say, is probably, maybe fairly valued. It's not extremely cheap. But yes, I mean, all the things you're talking about this morning, I mean, all the headlines are negative. Remember, back in February, when we were at 6,000 and above, all the headlines were positive. And at least now, I mean, if you get any small piece of good news, even if it's, short term, I mean, you'll have a rip in this market. Again, we think for those investors, I guess, on the other side, who are over their skis, have too much equity risk, we would then use that rally potentially to at least trim back towards long-term waiting. So it really depends on where you stand. But again, remember, today, all the headlines are negative. If we get one positive headline, you can see this market move pretty quickly.
All right, Keith. Keith Lerner, thank you for joining us. Truist Wealth, Co-Chief Investment Officer. Appreciate it.
Thank you.
Well, we mentioned Delta earlier. Of course, the share's up today, down on the year. The company has pulled its guidance this morning over the uncertainty created by tariffs, for example. Phil LeBeau has details. Of course, he is fresh off an interview with Delta's CEO as well. Good morning, Phil.
Good morning, David. We're not going to get into why the stock is bouncing today. Is it because it was so beaten down? Was it because they beat on very much reduced guidance for the first quarter? The bottom line is it's all about the guidance and the state of the outlook for Delta right now. And they said it point blank. They largely see business stalling right now. Those are Delta's words. That's not us putting words in there. They say growth is largely stalled. Softer domestic demand, both in terms of leisure as well as corporate travel. And the second half capacity reflects that. They now are planning flat capacity. Previously, they were planning for it to be up 3 to 4%. Here's Ed Bastian talking with us this morning on how he sees the market right now.
Trying to do it all at the same time has created chaos in terms of being able to make plans. So whether you're a corporate manager trying to figure out whether you want to step forward on an investment, whether you're a bond trader or in the markets trying to allocate capital, or even as a consumer, I think everything has stalled. And so there's been a freeze until we get better clarity. And the hope is the administration moves quickly through the uncertainty. I think our economy is going to continue to lose steam.
That said, Delta did give guidance for the second quarter, expecting to earn between $1.70 and $2.30. The estimate going into this morning was for $2.30, so that's below what the street was expecting this morning. Operating margin 11 to 14%, again below where the street was. Q2 revenue down 2% to positive 2%. And again, the street into this morning was expecting an increase of 1.9%. Put all this together as you take a look at shares of Delta. It's not a surprise that the company has said, you know what, we are not issuing full year guidance and pulling back until we have certainty in terms of what we expect, both in terms of bookings later this year, corporate travel, domestic leisure travel. There's just too much uncertainty out there right now, guys. And that's the reason why Delta is not reaffirming the guidance it gave in January for full year results. And just one last thing to put this all in perspective. 3 months ago, we were here in Atlanta. Ed Bastian was forecasting record all-time great profits for 2025. Now they are essentially saying 25 is going to be flat, probably, compared to the rest of the year, although they're not giving guidance.
Yeah, Phil, you mentioned the corporate response here, and that looks very uncertain in terms of travel.
Yep.
Did Ed Bastian have anything to say about whether he thinks that there's been any kind of longer-term decline in demand from international travelers? I mean, are they able to even make any assumptions about whether this recent pullback in demand for travel into the U.S. is going to continue?
Well, they see strong demand in terms of what they had for international bookings, and this summer they expect that to continue. Now, having said that, Mike, they also don't have enough confidence in terms of corporate bookings and especially domestic leisure bookings in order to say this is what we expect for the second half of this year in terms of earnings or for full year earnings.
Gotcha. Phil, appreciate it. All right, still ahead, CEOs starting to break their silence when it comes to tariffs, including our next guest, who says they've gone too far. The CEO of Ethan Allen joins us next. Don't go away.
NBC.
Treasury Secretary Besson pushing back on weak economic sentiment this morning. Take a listen.
I can tell you that there is a little uncertainty, but that in general, the companies that I've spoken to, the people who have come, the CEOs who have come into Treasury, tell me that the economy is very solid. We got some very good jobs numbers last Friday. So, I think that we are in pretty good shape.
I'm hearing a bit of a different story. Of course, other CEOs have started to sound the alarm on tariffs. Our next guest company boasts that 75% of his product is domestically manufactured, and even he says tariff tactics have gone too far. Joining us now is Ethan Allen, CEO, Farouk Kathwari. Good to have you here.
Yeah, it's a pleasure. Good to be here.
I would hear 75%, and I think, oh, you're in decent shape. Why do you say they've gone too far?
Well, I think that there's always a question of how, the limit of how far you should go. And in terms of making changes, I think the changes were needed. Look, okay, we took the position, we've been around for 93 years. We maintained manufacturing in North America, United States, Mexico, Honduras. That's given us a great advantage. And so we have an advantage. What I'm getting at is, as a consumer, somewhat is concerned.
Yeah.
And from that perspective, I think we have to be careful that we don't get the consumers too concerned.
Too much too soon, perhaps. What are the actual numbers for your company? You mentioned Honduras, Mexico. Have you determined to any satisfactory standpoint what your cost is going to look like as a result of these tariffs?
As I said, 75% of our furniture is made. Now, we also purchase accents, lighting, and textiles, rugs. They come from different parts of the world. Our manufacturing in North America, there I don't think we have an impact on any cost issues.
You don't? None at all?
No, not at all, because of the fact there were some tariffs that were placed in Mexico, Honduras, but not to the degree that we have seen, say, taking place in East Asia. So from our perspective, our cost factor of products that we make in the United States, Mexico, and Honduras has not changed too much.
So you're not going to be raising your prices to consumers?
No, we may, but not much. The reason is this, that approximately 75% of the products are made in North America and 75% custom. 25% of it is made in different parts of the world. There is an issue of changes in costs and prices. So it's possible that, we have said publicly that our gross margins right now are about 60%. With the changes that were made, first-time changes, it took our gross margins down by about, if we did nothing, about 3%. Now, with the other changes that were made yesterday or day before, another percentage. So we have approximately gross margins going from 60% to about 55% or so, if you make no changes.
If you don't increase price, or what, don't fire people to increase your margin? I mean,
we don't have to fire people because of the fact that, look here, we took a lot of steps up front not to fire people. We got good people. We have, in fact, if anything, in the last year, we've added a few people. We have not gone too far on each side. So I think that as far as we're concerned, stability is important. And interestingly, the thing is this, the last couple of weeks when we started this whole question of tariffs, consumer confidence was impacted. But certainly for us, in the last couple of weeks or so, people are coming back to us because they see our products, they see more stability. We make the products in North America.
So Farouk, you said 60% margins and you make most of the products in North America. But what about the rest of the industry? Because I get the feeling some of your competitors are much more exposed to overseas markets. Do you expect them to bring the factories back? Are they able to do that economically? What do you think is going to happen broadly? Because most furniture isn't made here, is it?
No, it isn't. And it's not very easy to bring manufacturing back. There are a lot of factors to bring manufacturing. Look at our manufacturing. 20 years back, we had 20 manufacturing operations in the United States. So at that time, we decided, what should we do? So we said no. People were going to overseas. So we said no, let us go south of the border. So we said we'll go to, first we went to Mexico, then we went to Honduras, and today we have 20 manufacturing, 10 different locations. Now we have concentrated in Vermont, North Carolina, central Mexico, and Honduras, making 75% of our products. Now we've got to be careful. If you're all over the place, not easy. And because of the fact we are able to do that, like for instance, in Honduras, we supplied them wood from our lumber operations right here in the United States. Our products that are made, 75% is custom. That keep in mind. Our competition, maybe 100% is not custom. They make the products overseas.
I know, but aren't you an anomaly in the industry? I mean, we saw some of the plunges in shares of RH and Williams-Sonoma. What's going to happen to furniture as an industry?
Well, it's a lot of concerns because the fact that to make changes, look at what's happening in China. We have small exposure in China. We have actually 40 Ethan Allen location retail in China.
I guess, though, what I'm wondering here, you keep talking about 75%. Your competitors may be much more disadvantaged by tariffs. So I'm wondering why you're actually on the record saying they've gone too far. I'm not getting it.
No, I didn't say they've gone very far. I said...
Too far. I thought you said too
yeah,
far.
I
No?
said,
Am I wrong?
Too far.
Too far. That was what you were quoted as.
Yeah, it's a relative term because the fact that 25-30% is, as far as I'm concerned, too far.
Too much.
But too much. I'm not saying this shouldn't be. Look, we are less impacted. But I think it also has an impact on consumer confidence. We are not. We are actually benefiting.
Right.
But it's a short-term benefit. I think this should be managed, it should be monitored, and we should not go as far.
Are you already seeing a slowdown with the consumer?
No, interestingly for us, there was somewhat of a slowdown last month. But interestingly, the last 2-3 weeks, consumers are coming back to us. It's because of the fact of our positioning. It's not just only consumers.
Right.
We have the largest interior design network. They have great relationship with clients. We are getting the message across to them about the quality of our products, the fact 75% is made custom in North America.
Yep.
And that message is getting into clients, and our business is holding up, and in fact doing better.
Farouk, always appreciate it. Thank you.
It's always great to be here.
Nice to see you.
Thank you. As we head to break, check out the biggest gainers in the S&P 500 this morning. By the way, the S&P is up 0.4%. Nasdaq's doing even better, up 1.3%. And it's driven in part by, we mentioned Delta sold off into the release. It's bouncing. Some of the tech names are working today as well.
NVIDIA up 4%. It's big.
NVIDIA is a big help. Yep. Again, some of these hard-hit names. Apple also is making a comeback. Microsoft, Tesla, Amazon, Broadcom, they're all higher today. Plus, the playbook for tariff volatility with one longtime market vet. We'll talk about if and where to put your money to work from here after a quick break.
ambitiously.
Our next guest says Trump's tariffs are a way to front-load the pain and expect a gain with tax cuts and deregulation on the horizon. His top holdings include NVIDIA, Microsoft, and Alphabet. Bob Dahl, Crossmark Global CEO and CIO, joins us now. Bob, I guess that was sort of the overarching plan, is sort of the pain before gain. Question is really what the cost is up front. What do you think the economy is in for if these tariffs stay in place, and how you're navigating it as an investor?
Yeah, the pain gain comments are hope that the plan will come out that way, as you point out in your question. Who knows? We're taking some economic pain, and every day that goes by where we have these maximum pedal to the metal tariffs, the uncertainty level, the economic weakness. I mean, every time you turn around, there's some economists lowering economic growth expectation, raising inflation expectations. That's not a good combination. So I suspect this noise, this pain's not over as the economy begins to feel the effects of the big headlines around tariffs.
And the big question, one of them obviously, has been just to what degree the equity market has itself front-loaded the impact. I mean, we obviously have some very historic conditions, oversold, washed out. You don't see this kind of stuff except when markets are under severe stress and are discounting something pretty scary. But is that enough?
Correct, Mike. That's the big question. Look, technically, you pointed out some, put call, the advanced decline volume. We've seen some attempts at a rally. We'll get another one at some point in time, but I think we'll have to retest, and then the question will move to the fundamentals. And the fundamental question is, how bad is the economy and therefore earnings damaged? My guess is we got a lot of estimate cuts in front of us, starting with the first quarter releases, and outlooks going forward are going to be either I have no idea, or they're going to be a little bit lower. So I don't think we're going right back up to new highs. That they're going to fool around here. Let's hope we can stay in the 5 handle for the S&P 500. I fear we'll go back into the 4s, and of course, if we have a recession, we could go to 4,000.
Yeah, I mean, obviously, that's certainly on the outside of the probabilities historically. We've been talking all morning, Bob, about the bond market, and obviously, in the last little while, Treasuries haven't been doing their job in a mixed portfolio in terms of offsetting equity risk. What do you make of it? And I guess what are the knock-on effects?
Yeah, you guys have covered it well. Hedge funds, concern about deficits, foreigners not buying our paper, all those good things. Look, it's just in the world we grew up in, lower growth almost always meant lower interest rates. And while that's still true, there are a lot of other cross currents now that we have to worry about. Our view has been that the 10-year yield this year is going to oscillate between 4 and 5. When you get toward 4, which we were not that many hours ago, you got to let a little go, and you move back up over 4.5. You got to do some accumulating again. So we would use bonds as a trading range, not expecting a 3 handle or, God forbid, a 5 handle.
I think you were on with us a few days ago, Bob, after sort of post initial sell-off on the tariffs, and saying you were switching from names like Coca-Cola to NVIDIA, making moves like that because of the valuation, just like what's being discounted. Is that still your tactic here, or have things changed? And how's that working out?
Yes, it's working out reasonably well. That particular trade is a good example of the pair. I mean, NVIDIA's multiple's lower than Coca-Cola's. Looking at that, and if anybody does, a 3-year to 5-year time horizon, I think NVIDIA is going to be a better stock than Coke from those starting levels. Coke near an all-time high, NVIDIA a 40% decline. So still doing that, but I want to emphasize at the margin. Not trying to be a hero. I still own a bunch of Coke. And slowly increasing my NVIDIA position.
Yeah, certainly a lot of folks want to see semis come off the mat if this market rally, if the next one is going to have any real credence. Bob, good to talk to you. Thank you.
All the best.
Well, they're working today. It's the best performing group.
It is
Information technology rising to the top. Although the Dow is down 111 right now. S&P back on the flat line. So we've lost some gains. We're losing some gains as we speak. Coming up next hour, we'll get a fresh read on how the consumer's holding up. The CEO of Kava joins us, who's also got some strong words when it comes to the tariffs. He joins us at 11. Don't go anywhere.
Shaving.
Stocks of pharmaceutical companies, you can see some of them right there. They are down rather sharply this after a new tariff promise from the president last night. Take a listen.
We're going to be announcing very shortly a major tariff on pharmaceuticals. And when they hear that, they will leave China, they will leave other places because they have to sell. Most of their product is sold here. And they're going to be opening up their plants all over the place in our country.
Let's get to Angelica Peebles. I'm also curious how long it takes to build a manufacturing facility for pharma. Angelica, take it away.
Yeah, David. So a flat tariff on pharmaceuticals across the board would be pretty straightforward, more than the different rates that we saw announced last week. So if the main ingredient of a drug is made overseas, it's likely going to be subject to a tariff. Leerink analyst David Reisinger says that every large pharma company he covers would be affected. But calculating the individual company's exposure is basically impossible with how little they disclose. So the two key variables here are where the main ingredient of a drug is manufactured and who pays for the intellectual property of that imported drug. And the latter detail significantly affects the price that's ultimately tariffed. So on its own, a drug might only be worth the cost to make it, and that's much less than what drug makers charge for it here in the U.S. But when the IP is factored in, it's valued much closer to the list price, and Reisinger says that would result in a far bigger hit to earnings. So while we wait for the details, one lawyer told me that companies are scrambling to sort through their supply chains and the transfer prices of the drugs that they're importing into the U.S. But another lawyer told me that despite what the president says, he doesn't expect to see companies make any meaningful changes anytime soon because there's just so much uncertainty, and these are not easy moves. David, you asked about the time it takes. It can take about 5 years to open a new manufacturing plant. So you might go ahead and do that today, but the tariffs might not be around 5 years from now. So we're really going to make that move right now.
It feels like it was working, the threat of tariffs, because Lily, a month ago, I remember when David Ricks was on with you, talking, they were going to double manufacturing investment in the United States and open 4 factories. Question is, once these tariffs go through, whether they'll still be able to do that because they're going to be having much higher costs.
Right, but if you remember what Dave Ricks said, the big factor in that decision to do more manufacturing in the U.S. was the 2017 tax cuts, because a large factor in why so much that manufacturing has gone overseas is the tax rate. And so now with lower taxes in the U.S., that is the main incentive. And so that's the critical piece here.
Angelica, thank you. Angelica Peebles with an explanation on that potential news about tariffs on pharma. As for our broader markets, of course, we're keeping a close eye on them and the bond markets. We are back in negative territories. You can see on your screen in the S&P. NASDAQ still eking out a third of 1% gain. We got a lot more market coverage for you straight ahead.
you
NBC.
Good Wednesday morning again. Welcome to Money Movers. I'm Sarah Eisen with Mike Santoli live at Post 9 of the New York Stock Exchange. Another volatile day here on Wall Street as stocks right now lose those early gains. We were down, we were up. Now we're heading south again, down 0.6%. The NASDAQ hanging in there, but it has been outperforming. Apple still higher, Nvidia, Microsoft as well. But it's been all over the place. This has been very characteristic of how we've been trading lately. Russell 2000 index of small caps getting hit the hardest now, down 1.5%. So not the kind of steep declines we've seen in recent days, but we are seeing the selling picking up here as we move through the morning. The S&P 500 is about 12% lower from where we were before the tariff announcement last week. Bond yields, a big focus. They are moving higher again today. Third day in a row we've seen this. The 10-year right now, it's nearing 4.4%. It has been surging, especially overnight. The long bond people are watching. The 30-year yield, 4.83%, hit 5% overnight at the highs. So we'll continue to watch that, not acting like a safe haven as stocks sell off here. Tech and consumer discretionary are the leaders. Healthcare and utilities are lagging at the moment. The Mag 7 stocks are seeing a bounce. I mentioned Apple, but the group is still down 30% from their peak. And the consumer trade in the green. Airlines higher on the back of Delta results. Retail names also higher, with Walmart leading the gains after updating guidance there. We'll start in Washington, though, as countries around the world begin to announce retaliatory tariffs against the United States. Megan Casella with the latest. Morning, Megan.
Hey, Sarah, good morning. So some of our largest trading partners fighting back this morning against these tariffs. The European Union this morning voting to approve its first round of retaliatory tariffs. Those will start to take effect next week, and they'll target a broad range of goods. Meat and cereal on one hand, vacuums and diamonds. It's not a massive list to start with, but I will say that's because this round is a response only to the steel and aluminum tariffs from last month. European leaders have vowed a more forceful retaliatory response is still to come in response to the country's specific tariffs that took effect today. Then, of course, we know China also upping its retaliation today as well, bringing its new tariff on all U.S. exports up to 84%, matching that new rate that the U.S. put into effect at midnight. Beijing also added new restrictions on about 18 U.S. companies, making it more difficult for all of them to do business in China or with Chinese companies. And guys, the big question from here, of course, is how much further this can go. Is this the end of the tit for tat, or are we really just getting started? And I'll say when it comes to China, it is not clear that there is much conversation at all between these two countries right now, or even that the White House is really all that concerned about this retaliation. A telling quote this morning, Treasury Secretary Scott Bessent saying that while no one wins in a trade war, China will be hit harder than the U.S. And he said, quote, they can raise their tariffs, but so what? I'll also say the U.S. Trade Representative Jamieson Greer, he's on Capitol Hill again right now for the second day in a row. And he's also told lawmakers that the administration is not prioritizing talks with Beijing. So the writing on the wall here, guys, is that it could be at least quite some time before we see a détente with China. Guys?
Megan, we, of course, in recent days have heard about delegations coming in from South Korea, from Japan. Secretary Bessent again today talked about maybe some talks with allies to perhaps come to some terms. Do we have anything tangible on that? Is there a process underway?
There's many talks underway. They started by saying 50 nations. Now they're saying 70 nations that there are talks ongoing with. I'll say Greer, the trade representative, also just said that yesterday, after his first hearing before the Senate, he had 4 meetings yesterday. I think it was EU, Korea, Mexico on that list, maybe Vietnam as well. We know Vietnam is having talks in addition to Japan and South Korea. So the list does keep growing. But what is still unclear, at least publicly, and it seems like it might be unclear to these countries as well, is exactly what they need to offer in order to get some sort of a deal. There had been a lot of hope that something might be struck before midnight last night when these tariffs took effect. Now, but of course, they're all in effect now. Some people still do think that there is some lead time here to get something done because these tariffs don't apply, not to get too technical here, but they don't apply to goods that were already on the water. But anything being shipped today or in the future will have to pay the tariff once it gets to the U.S. So some people think there might still be some time there to negotiate something before the consumer and the price impact really starts to hit. But obviously, we're very much down to the wire here, even past the wire. And there's still a lot of talk about what exactly this administration wants to see.
Well, and what the negotiations look like and what the goalposts are, I guess they'll be tailored for different countries. But like, what would be acceptable? You know, I thought it was interesting that we saw Prime Minister Netanyahu come to the U.S. to try to and partly negotiate away those 17% tariffs on Israel, a friendly relationship there where they said they'd drop all of their tariffs to zero, and he didn't walk away with a deal.
Yes, and they're not the only country. Vietnam also said they dropped all of their tariffs to zero, and we heard Peter Navarro on our air saying that is not enough. And Vietnam, of course, getting one of the steepest tariffs in the bunch here. There was an interesting quote from Greer yesterday, and he did suggest that it wasn't just about cutting tariffs, but that if countries had any sort of good idea about how to reduce the trade deficit, that's what the administration cared most about. So maybe that was commitments to buy a whole bunch of goods from the U.S. The secondary question is, how does that get enforced? We've seen these sorts of deals before with China in particular, and they never followed through. But maybe it's commitments to buy more from the U.S. Maybe it's commitments to reduce some of those non-tariff barriers, reduce regulation or some environmental standards. We just don't know yet. But as you said, the goalposts keep moving and are kind of hazy as to where they currently stand.
For sure, yeah. We can hope for some kind of terms that allow both sides to declare victory. We just have no idea what that might look like. Megan, thank you. Let's get back to the markets with our next guest, who sees 50-50 odds of a recession and no rate cuts from the Fed this year, barring a sharp spike in unemployment. Joining us here at Post 9, DWS Group, America's CIO, David Bianco. David, seems like a pretty tight squeeze there. If you're basically a coin flip from a recession, but you think the Fed is sidelined, how do you invest through that?
Right. Well, first, this retaliation by allies and the sharp retaliation from China is exactly what investors feared this week. So things aren't looking so good. Watching the retaliation, watching the duration of the tariffs, how high, how long they last, watching the equity market, because the wealth effect is important. So confidence is being lost rapidly by allies and investors. So sure, the risk of a recession is going up, but I think it would be a different recession than usual, one that's not as deep, but could linger. I'm in the stagnation camp.
Why would it be different than you? Well, I guess, first of all, I see your point. It would be kind of just a sort of a cost-driven consumer confidence, CEO
not deflationary, inflationary. I don't expect credit costs to surge.
And yet, so much focus recently on capital market stress points and whether, in fact, we do have some kind of mishap, whether that means the Fed comes in or whether it just means it creates further unanticipated effects.
So one of the reasons why it may not be a sharp recession, may linger because it's inflationary, not deflationary, but yet monetary policy and other policy, not even fiscal policy, can really respond, is because this is could be a recession, I believe a stagnation that has higher inflation, and that's what's alarming to the long-term bond market. In accelerating inflation while the economy is sharply decelerating, that should bother long-term bond investors after 4 or 5 years of inflation being well above the Fed's target, and it looks like it's going to stay above that. So the Fed has lagged in fighting inflation. The Fed's going to have to must lag now in fighting the slowdown.
Sounds like you're above 50% recession. You might need to adjust that.
50-50, we need good decisions being made every day from this point.
I mean, the market feels like it's pricing in more than a 50% chance of recession now. Or 20% from the high, right?
Well, the market is right at bear market territory. On 4,900 at the S&P would be that. A typical bear market decline is something closer to 25%, not crashes or greater. 1974 was a bear market and then a bear market. So I think a lot of damage has been done for now. But if things don't improve on this trade front, it's not the end of the day.
Are you spooked by what's happening with bond yields?
I'm not surprised about this, actually. It is concerning. It was definitely one of the risk cases that we're in a situation where the Fed shouldn't cut, in my view, unless unemployment surges. And the Fed needs to focus on keeping the confidence of the long-term bond market. Secretary of Treasury is focused on that as well, but inflation's a real risk, and Treasuries are not providing a safe haven. That can mean new, normal, higher long-term yields.
One way to frame what's been going on is, you've had this huge sudden plunge. You had just very, very relentless selling for a period of time in equities. And what we're searching for is maybe signs that acute phase might be ready to end, right? Where you have the shock, and then it's sort of okay, we can sort of try to assess the damage from here. It's been elusive so far. And obviously that's because the news flow and and just the range of possibilities is so wide.
A lot of damage done so quickly. So if there's more damage to come, it probably comes slower over time.
Okay.
There's some shopping to be done. One of the opportunities that I think has emerged, big cap digital stocks, they're not as exposed to the tariffs, but they are exposed to the economy abroad, but in a better position, valuations less demanding. I still like healthcare and utilities, and people will be looking for inflation protection when the dust settles. So there are shopping opportunities, but I don't think you should expect a sharp rebound. These tariffs are not going to be canceled. They will be negotiated lower, but they will stay high versus anything we've been accustomed to. That's the new norm.
So how do you craft earnings numbers? Like I mean, companies have already started pulling guidance. How do you determine what the outlook is?
Yeah, it's work that I do very closely. I'm still waiting to get some more information on exactly what the tariffs will look like next week and the weeks to come. Let's put it this way. The S&P did $245 of earnings last year and $260 of annualized earnings at the fourth quarter. At this stage, we'll be lucky to keep earnings up rather than down. So 260 and 260 times 20, that's 5,200. I think that's a very full fair value for the S&P at this moment.
So that feels kind of like a fundamental ceiling, perhaps, what you might want to expect.
Precisely.
All right, maybe you take it now.
No, we'll take it right now.
200 points from here. David, good to see you. Thank you.
Thank you. Thanks.
We've been talking about the move in bond yields higher today. Our Leslie Pickard joins us now with more color after speaking to some trading desks. What do you hear, Leslie?
Hey, Sarah. Yeah, just been on the phone most of the morning talking to some trading desks to get some color. There's a lot of conjecture out there about whether some of the violent moves we've seen in the Treasury markets are due to foreign selling potentially an unwind in a pronounced way of the basis trade. Here's what I can tell you after speaking with some people. First of all, I'm told that liquidity conditions are deteriorating, not to levels that they saw in COVID, but bid-offer spreads in U.S. Treasuries are approximately double their normal levels. Hedge funds de-risking out of certain trades, such as long U.S. Treasury swap spreads, reflecting a change in view of the credit quality of U.S. debt. However, I am told so far this has been orderly. And, speaking of that basis trade that I mentioned, I'm told that the cash futures basis trade has not deteriorated meaningfully. Repo funding markets remaining relatively stable. That, of course, is something to watch as it pertains to, meaningful stress where you would need some sort of intervention. Keep an eye on repo, keep an eye on commercial paper markets and the like. I'm told with regard to foreign sellers, and this is from a couple of trading desks, that it's possible there are some foreign sellers, but there isn't much evidence in terms of flows that they're selling, that they're dumping treasuries in a big way. I'm told that if that were happening, we would see much more disorderly markets than we're seeing now. But of course, there are a lot of levered positions relative to treasuries. So you see things like a weak 3-year auction from yesterday. Any concerns around the U.S. And its loss of status as a treasury haven, as treasuries as being a haven there, you do see kind of a result from those things that these positions get unwound quickly, which is why you've seen a lot of volatility over the last few days, guys.
Yeah, we'll watch that auction later today as well.
Yes.
Could be a clearing event potentially. Who knows? I mean, the color is very helpful, Leslie, especially as it relates to what people are doing with treasuries right now. Leslie Pickard, thank you very much. And it really all comes down to this question about the dollar, because you buy treasuries as a safe haven. And I do wonder if there are questions about that. And it's hard to know right now. Leslie said, and I'm hearing too, little evidence of big foreign selling. Do the rating agencies sound any alarms? Does this test the credibility on U.S. policy around U.S. Treasuries?
Yeah,
that's a key question.
I mean, it's tough that those are the questions that we have to ask right now. It's interesting because there are all those candidates for who may be the marginal seller that Leslie put out there. But the bottom line is that it just hasn't been as much of that offset volatility, shelter, safe haven demand that you would otherwise expect to see, right? You would expect to see more of a bid to offset whatever the forced selling is. So we'll see. I mean, look, the levels aren't that alarming in themselves. We were here not that long ago, 4.5% or so, or just below on the 10-year. It's just how fast they're getting there. It's always the case. And, if as Leslie says, the prime brokers think that this is an orderly unwind of a popular hedge fund trade, that's great, but how much more is left?
Sure.
That's what we don't know. Yeah.
All right, we'll keep an eye on it. 10-year yield just below 4.4, dollar weaker. Still to come, what the market downturn and volatility means for deal making and the IPO pipeline.
Plus, we are watching Walmart pulling its quarterly operating income forecast, citing tariffs. The company saying it wants to maintain flexibility in case it has to spend more to keep prices low. Walmart did reaffirm its full-year guidance, however, saying nothing in the current environment changes our strategy. You see the shares are up on the day. We'll be right back.
Welcome back to Money Movers. Wall Street beginning to gauge the ripple effects of tariffs, including tech, deal making. Our next guest says the recent sell-off could cause deal activity to be pushed into the second half and could cause the IPO market to run cold for a few months. StubHub and Klarna, the latest names delaying their IPOs as this tariff uncertainty grips the market. Joining us here at Post 9 to discuss is Barclays Global Head of Tech Investment Banking, Kristen Roth de Clark. It's great to have you back. Welcome, Kristen. So what are you seeing right now? Is the uncertainty having an impact on your clients?
Well, we came into the year expecting a robust M&A market, expecting a robust IPO market. We had CEO confidence at highs. The recent uncertainty has really created a lot of volatility, obviously, in the market, which has put a pause on M&A activity and IPO activity. I guess the best definition of measurement of volatility would be looking at the VIX. Obviously, we saw the VIX close yesterday above 50 for the first time since March 2020, the start of COVID.
So what are you telling your clients about when?
Well, on the IPO side, we're continuing to work with our clients. No one's gone pencils down in terms of preparation for an IPO. What we really need to see is stability in the general market, and a lot of that will hinge on volatility coming back down below 20. If we see a sustained level of the VIX below 20, say a week, 2 weeks, that will start to give us confidence that we can start testing investor appetite for IPOs.
In terms of venture-backed IPOs, when they have private owners, do you feel as if they can afford indefinite patience on things, or do you feel as if they feel like they get to a certain scale and size and they simply either not so much need an exit, but they don't want to fund the next round of growth privately or something like that?
There's pent-up demand for liquidity from both venture capital and private equity, and that's what we were expecting, a pretty robust IPO market. That doesn't change. The backlog is massive. I think the conversations we're having are on, does the IPO make most sense, or are we also looking at dual track processes on the M&A side?
Even if we get recession?
Yeah, well, look, at some point, we're going to get to a clearing level from a valuation standpoint, and there will be increased deal activity. The stuff that we're seeing now with the way that the market has traded down is more interest from private equity firms, for example, in take privates. And we've seen an acceleration of take privates so far this year, even before we saw the sell-off over the last week.
That would make sense, I would say, fundamentally, in terms of, okay, it's a software company or something, they're not really tariff impacted directly, and you get the valuations low enough. But private equity is feeling like they can fund deals at this point and get the leverage they need?
Well, it depends a little bit on the financing market, and we're seeing some moves in fixed income as well as equities, and so I think that remains to be seen in terms of the financing environment, but the willingness is certainly there. I think the things we're looking for from a corporate performance standpoint, on the consumer-facing tech names, it's going to be, is there a shift from consumption to savings? And so watching some of those economic indicators that will come up on consumer spending later in April. And then on the enterprise side, we are watching for, and investors are looking really at, do we start to see elongated sales cycles as an indication that there may be, the corporate health of some of these software companies, for example, could be slowing.
I mean, there was so much optimism going into the year around deal making in particular. Lena Khan was out at the FTC. It was going to be a whole new regime, Republicans in charge of regulation. I just wonder how much of that gets preserved given the environment we're in, of uncertainty, of tariffs, of now questions about recession?
Well, I think once we find stability in the market, there actually is increased optimism, I think, since I was last here in February, around the regulatory environment for M&A and technology, even large-scale M&A and technology, provided it's not directly competitive or has any association with or risk with China.
But it's going to just go back to, pre the FTC of the Biden administration.
Potentially.
Is that what you mean?
Potentially.
All right, well, definitely keep us posted, Kristen. It's good to have a sort of real-time indicator of what companies are doing. Thank you.
Thank you.
From Barclays.
There's still to come. The CEO of Kava is with us on how they are navigating tariffs and a cautious consumer right now. The stock is down 30% so far this year.
And take a look at the market right now. Again, we've been down and up and up and down, and it's one of those crazy volatile days. The S&P has now come back higher, 0.4%, so kind of indecisive here. NASDAQ up 1.2%. So we were heading south at the top of the hour, and now we've recovered a little bit. Again, it's tech leading the gains. Apple, Nvidia, Microsoft, Tesla. Under pressure today, you have more of the defensive groups that have worked better. Utilities, healthcare, real estate. Energy, though, still down. The financials are a little bit weak. We'll be right back.
NBC.
Welcome back to Money Movers. We are seeing a big move in crude this morning. Let's get to Pippa Stevens for more on that drop. Good morning, Pippa.
Good morning, Mike. Well, WTI tumbling as much as 7%, dropping to a 4-year low of 55.33, with Brent breaking below 59. Crude is now down $15 this month, a blistering pace with little relief in sight as oil takes a hit on both the demand and supply side. In terms of how much more downside there could be, Rebecca Babin from CIBC Private Wealth saying that oil absolutely should not break below 50 based on fundamentals, but that in this type of trading environment, things can always get much worse than you think because it's about leverage and liquidity. She added demand growth estimates are now at about 500,000 barrels per day, down from 1 million barrels per day at the start of the year. Meantime, Goldman saying that in an extreme scenario of both the global GDP slowdown and a full unwind of OPEC plus cuts, Brent would fall below $40 by late next year, although their base case is for 62 on Brent at the end of this year and 55 next year. One bright spot, though, for consumers should be gas prices. We saw the national average last week rise to the highest since September, but gasoline futures are now down 18% in the last week, which should start to be reflected at the pump. Sarah?
Okay, Pippa, thank you. We'll turn now to global markets because there's lots of action abroad as the U.S. tariff rollout takes hold, and so do retaliatory tariffs. European stocks moving lower, but they are off session lows at the moment. The ECB raising concerns around the developing trade war. The head of the Dutch central bank saying, quote, "We are stuck with the fact that a trade war is a negative supply shock and is a stagflationary shock." That's as investors expect the ECB to accelerate its rate-cutting path, now pricing in a 90% chance that they cut again on April 17th. That is next week. Meanwhile, in Asia, the Taiwan index ended the day down nearly 6%, hitting its lowest level since January of last year. The Nikkei in Japan lower by almost 4%. The Shanghai Composite in China, Hong Kong's Hang Seng, both ending higher on the day for a change. However, still on pace for the worst week since October 2008. Finally, plenty of action in currencies. The People's Bank of China weakening the offshore yuan for a 5th straight day in an effort potentially to offset tariff-related economic concerns. There's so much going on, but one central question, Mike, that investors are asking now is if this is the end of the U.S. exceptionalism trade, where do we go instead?
Yeah.
Because on one hand, countries in Europe and China will be hit harder than the U.S. economically. Their countries are more tied to trade on the tariffs and the back and forth. But on the other, they are more in stimulus mode than the U.S. and might benefit from some of this flight out of U.S.
Europe has less of an inflation overhang. They can cut more. You know, the equity markets in Hong Kong and China are interesting. You can never know what to make of one day. But also with the currency going down, that's obviously probably part of that as well. So there's adjustments happening there. But I agree, there's no one dominant replacement, not just for the U.S. consumer as the engine of growth and our market as a kind of soaking up a lot of money in our asset markets. Even the Mag 7. I mean, that was the most crowded global trade because that was the really U.S. exceptionalism in terms of the market was we have these great globally dominant tech companies that have premium valuations.
That hasn't changed.
It has not changed at all. It's the valuation you put on it probably that might have gotten moderated for now.
Yeah, I mean, watching the dollar, I still buy the there are no alternatives
That's right.
story.
Certainly no single alternative, and so it's a matter of just
treasuries.
chaos otherwise.
But it is weaker again by 0.75%. And this has been somewhat of a surprising move on the back of tariffs.
Yeah, a little counterintuitive. That's right. All right, time now for a news update. Silvana Henao has that for us. Silvana?
Hey, Mike, good morning to you. The death toll from the nightclub roof collapse in the Dominican Republic has climbed to 113. Emergency management officials say 155 people were taken to local hospitals as rescuers continue to search for potential survivors. The cause of the collapse remains unclear. The club says it is cooperating with authorities. A key hearing for the man accused of murdering 4 University of Idaho college students in their off-campus house in 2022 is underway this morning. Prosecutors and the defense are arguing some of the final ground rules ahead of Brian Kohberger's trial this summer. The hearing is expected to include arguments over whether Kohberger can be put to death if convicted and what evidence will be allowed in the trial. And Lego opened a $1 billion factory today that it promises will rely solely on clean energy. It's the Danish company's 6th factory worldwide and 2nd in Asia. Lego is also building a new factory in Virginia, which is expected to start production in 2027, Sarah.
Okay, thank you, Silvana. Up next, the CEO of Kava with a warning about the impact of tariffs on his business, food prices, and a cautious consumer. Not the only thing he's worried about. That's on the other side of this quick break. Stay with us.
Come and make it count.
Welcome back. Shares of Kava higher today, still getting caught up in the recent sell-off, down more than 10% in the past week, bringing total losses for the year to 30% as the company contends with newly announced tariffs and an increasingly cautious consumer outlook as it looks to expand throughout the country. Joining us now is Kava co-founder and CEO Brett Schulman. Brett, welcome. It's good to have you.
Yeah, thanks for having me.
First, on the tariff impact, what does that look like for you? How much food do you import?
Yeah, well, we source a lot of our food domestically. We do source some from Mexico, like avocados and produce that currently are exempt under USMCA. We do source our olive oil and our Kalamata olives from Greece, with our Mediterranean cuisine, and some packaging overseas, but a lot of packaging in the U.S. as well. Those U.S. manufacturers use paper pulp sourced from Canada in that packaging, although that continues to be exempt under USMCA. So not a significant impact, and we're really working to mitigate any need to pass through those costs to our guests, much as we've done the last 5 or 6 years as we've been able to underprice inflation almost 800 basis points.
So we won't say higher priced kava bowls.
We're working on that. Yeah,
What
that's our
about,
goal.
the other way that you get exposed here is, of course, through the consumer. And we've seen confidence shaken, and now there are questions about recession. Are you seeing anything yet?
Our consumer has continued to be really resilient with our value proposition. We want to be a port in a storm for them when it comes to the impacts they're feeling all around them. They can still come and get a really great meal at a really affordable price at Kava. So that's, again, what we're focused on delivering to them.
Are you still seeing the high growth that got investors so excited? And the stock is still a clear outperformer and the highest valued in the restaurant space.
Yeah, so really exciting. We opened our first restaurant in the Miami area just yesterday in Hialeah. We opened our first restaurant in Indiana and Indianapolis about a month ago. So we're very focused and steadfast on our long-term growth strategy.
So what does that mean in terms of the pace of new stores? Are you concerned about the cost of that expansion? Obviously you're talking about buildings.
Yeah, well, so for this year, it's baked. We've forward bought all of our kitchen equipment, materials, building out our pipeline. We are looking to see, how these tariffs play out in terms of future construction costs. And I think that's what's, important here is really getting certainty and what the outcome is going to be. We've kind of modeled out various scenarios and just understanding which scenario is going to be the one going forward.
How often do you change your menu?
So we have a pretty static menu. About 80% of our menu stays pretty fixed, and then about 20% will rotate during the year. We do what we call one tentpole moment. So last year that was launching our new grilled steak, and then bracket with a couple seasonal moments. So we launched our garlic ranch pita chips, which were our first flavor innovation on our fan favorite craveable pita chips. So you'll see us pulse that 2 to 3 times a year.
Just wondering if restaurants are going to be making decisions now about ingredients when it comes to changes based on cost.
Yeah, not at Kava. We've kind of architected our supply chain, built our supply chain to be resilient in the face of any of these changes.
What are you seeing in terms of, obviously Mediterranean has become, this very fast growing segment, and it's drawn a lot of competition. What are you having to do to sort of maintain the head start?
Yeah, we're focused on being the best version of Kava, and we think that's what gets us to success. So that's all the investments we've made, whether it's our manufacturing infrastructure to produce that tzatziki with fresh dill and fresh cucumber and take that complexity out of the 4 walls of the restaurants, the investment in our human capital and developing great leaders to run our restaurants of tomorrow, or our technology infrastructure and our digital ordering platform and our new loyalty program that we just launched that, again, can reward our guests in a time where they're looking for great value. We just launched on National Pita Day. Those pita chips I talked about, we did a free pita chip redemption for all of our guests so they could add that to their meal and have a little joy in a time of uncertainty.
I missed National Pita Day. Too bad.
Has that existed before you guys? Or what is that day?
It has existed, but it's a day that we want to really show up on, be relevant, because it's true to our brand essence.
Brett, how exposed are you to people at work? There are questions about what the employment outlook looks like. And I think of you as a place where people go when they're going for their lunch break. So what does that look like?
Yeah, that's the beauty, I think, of our success and the diversity of how we succeed. We are 85% suburban, 15% urban. We are 50-50 roughly lunch and dinner day part, right? So we have, if you look at the top decile of our restaurants, they're everything from a suburban end cap shopping center to an urban site with residential to an ex-urban freestanding site with a pickup by car lane window to a college adjacent site. So we have this really broad appeal for multiple consumer occasions, so we're not dependent on one single occasion.
You were around during the financial crisis, right? You were just getting started?
We were born just after that.
I was wondering, what happens during recession? COVID is kind of a weird example.
Well, looking back, if you look back at peers in our industry during the great financial crisis, there were brands that continued to comp positive in the face of all that challenge because they were delivering a great value to the guest, right? We serve lunch and we serve dinner, and if we can give you a better value proposition alternative than other options, whether it's food away from home or food at home, we'll continue those positive comp trends.
Yeah, that was kind of when Chipotle was just taking off, right, in those years.
All right, well, Brett, it was great to get an update on the business, especially good to hear you're not going to raise prices and all of this. Thank you.
Thanks for having me.
Brett Schulman, the co-founder and CEO of Kava.
All right, up next, we will hear from the CEO of Google Cloud on how tariffs and the recent volatility may impact plans for spending and CapEx. Plus, we are watching Apple, stock trying to break a 4-day losing streak. Yesterday, the most negative impact on both the NASDAQ and the S&P 500 coming from that stock. It is up 3.2%. Today, it is Jefferies upgrading to hold. However, the firm does lower its price target to $167 a share, saying the stock still isn't cheap. Right now, as we said, shares up 3.2%. I think the multiple's like 25 on a forward basis. Don't go away.
you